The week turned on a tougher message than the index closes first suggested. Welcome back to this weekly market recap. Tech broke first, inflation stayed too hot, and the market stopped rewarding the old AI leadership trade automatically. The mechanism is simple. When PCE is running far above target, the Fed has less room to help risk assets, even if yields dip after one data point. So buyers need to prove this is rotation and not a broader rejection. My base case is that the market can still try to bounce from fear, but I would not chase it blindly. Sellers have the better argument if growth leadership keeps leaking and volatility refuses to calm down. The macro block matters first, because this was not just a price wobble in technology. May PCE rose 4.1% year over year, so inflation is back above 4% while consumers are still spending. That keeps the Fed from giving the market an easy rate cut story. Core PCE at 3.4% is the sticky part, because it strips out food and energy and still sits well above the Fed target. Traders watch that because sticky core inflation keeps pressure on yields, equity multiples, and long-duration growth stocks. The PCE inflation line is the cleanest picture here. Headline PCE moved from 2.9% in February to 4.1% in May, while core moved from 3.0% to 3.4%, and both stayed far above the 2% target. GDP looked better on the headline, with Q1 revised up to 2.1%, but the details were weaker because consumer spending was cut to 0.5% and final private demand was lowered to 1.7%. Yields eased after the PCE release because the monthly core number did not shock traders, but cuts still look hard when inflation is this far above target, and the Fed just held at 3.50% to 3.75%. That leaves us with growth still alive, inflation still too firm, and buyers depending more on positioning, earnings, and lower oil than on real Fed flexibility. To me, this mix keeps stocks vulnerable if yields stop falling or if tech leadership fails to stabilize quickly. The Dow Jones Industrial Average slipped slightly on Friday, but still finished up about 0.6 for the week, so buyers were holding the old economy side of the tape better than tech. The S&P 500 was almost flat on Friday, but down about 2% for the week, and that tells me the broad market is giving back momentum instead of confirming a clean rotation higher. The Nasdaq Composite fell again and lost roughly 4.5% on the week. So growth is the weak link, and the former leadership group is now the stress point. VIX cooled on Friday but stayed up almost 10% for the week, which means fear eased into the close but did not disappear from the setup. Bitcoin bounced slightly by Saturday but still fell more than 4% for the week, so speculative risk is not leading buyers back into the market yet. That is why we start with fear-greed next, because extreme fear can create a bounce attempt. But it is also a warning that risk management matters before we trust the first rebound. I treat this as a bounce warning, not a panic bottom. Fear and greed is down to 25 after sitting near 38 a week ago and near 61 a month ago, so sentiment has moved fast enough to create rebound fuel, but not enough for me to call the low finished. The useful part is the history. Since 2020, 74% of extreme fear episodes lasted at least 2 readings, and 59% lasted at least 3, so the first touch usually is not an instant all clear. The other side is why I still respect the bounce case. In 76% of these episodes, the low was in by the 5th reading, and after first extreme fear prints, the S&P 500 was positive 21 trading days later in 74% of cases with a median move of 2.4%. That lines up with my broader view. I think the uptrend can survive, but buyers still have to prove it by pressing into resistance without fading and by calming volatility instead of just reacting to fear. So fear-greed starts the video for one reason. Sentiment is stretched enough to give buyers a shot, but the next SPY chapter has to show whether that shot is real or just another weak bounce inside a technology-led pullback. 30 years monthly log channel is the bigger warning behind SPY. I still think the broader uptrend can survive, but this is not a place where I want to chase blindly after the S&P 500 finally lost weekly momentum. May 2026 monthly close above the upper rail is the confirmed long-term signal here, so the market did achieve a real upside break. The problem is that the break is already being retested instead of extending cleanly. Upper rail near 729.86 is the decision rail now, and June is already back at that line. If buyers reclaim it from above and hold it, that would be a serious regime change, but right now I am not giving that path a free pass. RSI is around 75.1, so the market is stretched on this long-term view even before we talk about the shorter-term damage. Let me quickly switch to MACD, because momentum is strong but late. The MACD line and signal line are positive and sitting at record highs for this monthly window, so the trend has power, but it is not early anymore. Back inside the channel is the risk I respect most from this kind of stretch. Either SPY spends a long time moving sideways while the channel catches up, or sellers force a sharper reset before buyers get a cleaner shot. Current price is where the long-term caution turns into a real trading decision. Fear is already extreme, so a bounce attempt is possible, but SPY has to prove support is real and not just a pause after the weekly break. Support line has been active for roughly 61 sessions, and price is still testing it rather than breaking cleanly. For me, support still looks vulnerable here, so continuation lower is more likely than an immediate clean rebound. 50 days moving average is just overhead and acted as resistance today. That is important because buyers are not only defending support, they also have to reclaim the first major short-term line before the bounce looks healthier. 200 days moving average remains below as the broader trend floor, so the larger structure has not collapsed yet. That keeps the correction idea alive, but it does not fix the near-term selling pressure. RSI is still below 50 and fading, so momentum has not repaired yet. That pushes against the bounce case even though sentiment is already washed down into extreme fear. MACD momentum is fading below zero, so price confirmation matters here. Until that stops weakening, I cannot call this a clean bullish recovery. Volume overlay is the caution flag here because the 5 days average volume sits in the bottom 20% of this visible lookback. Participation is unusually light, and that makes any reclaim less convincing until buyers show stronger demand. Support is still the line that decides the chapter. If it gives way, the next downside focus is around 690.54, but if price pushes back up from here, the bearish pressure weakens quickly. The short-term path now looks like a reflex rally test, not a clean breakout chase. SPY is trading inside the A to B leg from 750.18 down to 716.58, so the first bounce can run into retracement resistance quickly. The nearest actionable retracement is the 38.2% area at 729.42, and the fuller sell zone runs roughly from 729.42 to 737.34. That lines up with the broader idea that buyers can bounce, but they need real acceptance, not a fast tag and fade. My tactical bias is to be careful with rallies into that zone. If sellers defend it and SPY rolls back towards 716.58, the weekly break stays active and the downside extensions around 707.44 and 695.82 come back into view. The counter-trend case is still there because fear and greed is already extreme. Some traders will buy the dip for a bounce into the retracement zone, but tight risk below 716.58 matters because a break there would turn the bounce attempt into another leg lower. That is the handoff into QQQ. SPY still has a possible corrective bounce path, but if Nasdaq leadership keeps bleeding, the broad index will have a much harder time repairing this support test. QQQ is the pressure point because the broad market can only repair if tech stops bleeding. The Nasdaq led the weekly sell-off, and that matters more because PCE stayed too hot for an easy Fed rescue. Price has bounced off the SMA 50 during each of the last 3 trading days, so buyers are defending the first major short-term line, but I would not call this repaired yet. SMA 50 is the line that decides whether this stays a controlled pullback or turns into a deeper leadership failure. A clean close back below the 50 days moving average would damage the recovery read quickly. Support line has been active for roughly 61 sessions, and price is still testing it rather than breaking cleanly. For now, I still lean towards support holding, but this needs follow-through fast. RSI is near the 50 line, so momentum is balanced rather than strongly directional. That fits a market trying to bounce, but it does not give tech a clean green light. MACD momentum is fading below zero, so the chart still needs price confirmation before this becomes a clean bullish read. This is the part that keeps me from chasing Nasdaq strength too early. 200 days moving average is still well below as the broader trend floor, so the larger QQQ structure has not collapsed. The problem is near-term leadership, not the whole long-term trend yet. As long as this area holds, the cleaner path is still a bounce back toward the middle or upper side of the structure. If buyers lose the 50 days and the support line together, tech stops helping SPY and the Dow rotation becomes the next thing we have to check. DIA is the rotation check after QQQ, and this is where the tape looks very different. Tech is leaking, but the Dow is still pressing the upper side of its structure, so the market is not acting like a full liquidation. Trend channel battle upper is the decision area here. Price pushed above the upper boundary intraday, then slipped back inside by the close, so buyers are still active, but they have not fully locked in the breakout. Trend channel battle upper reclaim close is what I want to see next. The previous session did close outside the channel, but the quick reset back inside tells me this boundary is still a fight, not a confirmed runaway move. Trend channel battle upper deepest tells me this has been a repeated boundary fight, not a one-day event. Since late August 2025, there have been only 2 breaks outside the channel, with the biggest closing excursion around 5.2%, so I treat the band as a guide, not a hard wall. RSI is still above 50, so momentum is constructive, but it is cooling. That means the Dow is helping the rotation story, but it is not accelerating enough for me to ignore rejection risk. Holding the upper band near 517.56 keeps the Dow trend in control, A rejection opens a pullback toward the midline around 502.25, and that would tell me the rotation is still alive but no longer strong enough to carry the broader market by itself. So DIA supports the idea that the uptrend is not dead, but it also says buyers need broader participation before I trust a bigger recovery. Next, we move to crude, because lower oil is the macro input that can either give this rotation more room or bring inflation pressure right back. Crude is the macro relief chapter after the Dow rotation. Lower oil helped remove part of the inflation pressure, but the Hormuz story is not fully resolved, so I treat this as relief with a risk tail, not a finished all clear. Price is below both major moving averages, so the crude backdrop remains defensive. That helps equities through the inflation channel, because weaker oil gives yields less fuel, but it also tells me oil buyers have not repaired the damage. 50 days moving average is overhead now, and that is the first reclaim level if oil tries to bounce. Until crude gets back above that area, rallies can still get sold. 200 days moving average is also above price, with crude roughly 6.6% below it. That makes the old golden cross fragile and raises the risk that this turns into a forward trend reversal instead of just a pullback. Support line is vulnerable here, and I still think continuation lower is more likely than an immediate bounce. If this support gives way, the next downside focus is around 64.86. Resistance line is the repair test if buyers do respond. A pushback through the upper side of this support and resistance structure would weaken the bearish oil read quickly. RSI has been below 30 for 5 straight sessions, so downside pressure has been heavy. That can create a snapback, but it is not enough by itself for me to call a durable low. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. That is the only reason I do not want to ignore a short-term rebound attempt. For the broader market, oil staying weak supports the bounce case because it cools one inflation input. The problem is that fresh Strait of Hormuz stress can rebuild the premium fast, and that would feed straight into the next chapter on yields and Fed pressure. TNX is the macro checkpoint after crude. Oil relief helped take one inflation input lower, but PCE at 4.1% and core PCE at 3.4% still keep the Fed pressure alive, so equities need yields to keep slipping, not just pause. Price is below the 50 days moving average but still above the 200-day, so the short-term rate move is softer while the bigger yield trend has not broken. That gives stocks some room, but it is not a full green light for growth yet. 50 days moving average is the first line yields have lost, and that matters because it weakens the immediate pressure on Nasdaq and AI names. If TNX reclaims that line quickly, the rate problem comes right back. 200 days moving average is still below price, so the longer yield structure remains intact. That is why I cannot say the Fed pressure is gone just because yields eased after the PCE release. Support line is vulnerable here, and I still think continuation lower is more likely than an immediate yield bounce. If that support gives way, the next downside focus is around 4.30, which would help the equity bounce case. Resistance line is the repair test for yield buyers. A pushback through that upper side would tighten financial conditions again and make the SPY recovery much harder to trust. RSI is still below 50 and fading, so momentum has not repaired for yields. That leans in favor of more breathing room for stocks unless buyers and rates step back and fast. MACD momentum is fading below zero, so TNX still needs price confirmation before I treat this as a bullish yield reversal. For now, falling yields support the broader bounce attempt, but sticky PCE means the market still cannot count on easy Fed help. That is the handoff into Nvidia. If yields keep easing, AI leadership gets room to stabilize, but if TNX snaps back, the same crowded growth trade that hurt QQQ becomes the next pressure point. Nvidia is still the AI leadership name, but the company news no longer gives buyers a free pass. Nvidia had fresh AI infrastructure support during the week, including production-scale AI work with AWS and partner hardware activity around newer Nvidia platforms. The problem is that traders focused harder on AI spending durability, valuation risk, and the broader chip stock unwind. That means good product news is not enough if the chart keeps losing leadership structure. Price is below the 50 days moving average but still above the 200-day, so the short-term read is softer while the bigger trend has not broken. That fits the broader market thesis. The uptrend can survive, but NVDA has to stop leaking first. 50 days moving average is overhead now, and that is the first reclaim line for this AI trade. Until buyers get back above it, rallies can still get sold as repair attempts rather than real leadership. 200 days moving average remains below price, so I'm not calling Nvidia a finished long-term breakdown. The issue is that leadership has moved from driving a tape to needing protection. Support line has been active for roughly 31 sessions, and price is still testing it rather than breaking cleanly. For me, support still looks vulnerable here, and continuation lower is more likely than an immediate clean bounce. RSI is still below 50 and fading, so momentum has not repaired. That pushes against the bounce case right when the broader market needs AI leadership to stabilize. MACD momentum is fading below zero, so price confirmation matters before I treat this as a bullish recovery. The chart is still telling me sellers have the short-term edge. Volume overlay is the caution flag here because the 5 days average volume sits in the bottom 20% of this visible lookback. Participation is unusually light, so even a bounce needs stronger demand before I trust it. If this support gives way, the next downside target is around 184.75, and that would turn Nvidia from a stabilizer into a bigger drag on the growth trade. If support holds and price pushes back up, the bearish read weakens quickly. That is why the next chapter matters. If Apple is also breaking down, then this is not just one AI leader under pressure, it becomes a broader mega cap weakness problem. Apple broadens the mega cap test because this was not only an Nvidia problem. During the week, traders had to price higher MacBook and iPad costs, more concerned about demand friction, and still unresolved AI timing after the earlier Siri delay headlines. That matters because Apple is not a pure AI hardware trade. If AAPL also needs repair, then the market is dealing with mega cap weakness, not just one crowded semiconductor pullback. Price is below the 50 days moving average but still above the 200-day, so the short-term read is softer while the bigger trend has not broken. To me, that keeps Apple in correction mode, not confirmed breakdown mode. 50 days moving average is the first reclaim line. Until Apple gets back above that area and holds it, this bounce is still a repair attempt rather than a leadership signal. 200 days moving average remains below price, so the larger trend floor is still intact. That is why I would not call Apple broken yet, even after the late week damage. Support line has been active for roughly 62 sessions, and price is still testing it rather than breaking cleanly. For now, I still lean towards support holding, but a clean close below this area would damage the bounce story quickly. RSI is trying to recover toward 50, so downside momentum is easing but not fully repaired. That helps the bounce case a little, but it is not strong enough by itself to call buyers back in control. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. That fits a possible rebound, but the chart still needs price confirmation. Volume overlay confirms participation here because the 5 days average volume sits in the top 20% of this visible lookback. This move is backed by unusually strong activity, so I do not dismiss the support reaction as a quiet bounce. As long as this area holds, the cleaner path is still a bounce back toward the middle or upper side of the structure. If Apple loses support after Nvidia already weakened, the broader uptrend thesis gets much harder to defend. That leaves the next chapter with the real test. The calendar has to give buyers macro relief because mega cap charts are no longer strong enough to carry a sticky inflation tape by themselves. Let's have a look at the calendar for next week. The jobs report is the big one, because this market is already fighting sticky inflation, fragile tech leadership, and a Fed that does not have much room to help. Thursday, July 2nd brings average hourly earnings and non-farm payrolls, with payrolls expected at 114,000 after 172,000 before. This is the labor check, and it can move yields fast. If payrolls are firm without wage heat, buyers can work with that because recession fear cools without forcing the Fed back into a tougher stance. That would be bullish for the market. If jobs or wages run too hot, that is not good for stocks because yields can jump and growth stocks lose breathing room. If jobs crack too hard, that is also bad because then the market starts trading growth fear. Wednesday, July 1st, starts the test with ADP employment change and ISM manufacturing PMI. ADP is expected at 118,000, and ISM is expected at 53.7 after 54, so traders are looking for steady growth, not another inflation scare. If ISM holds up without a hot price message, earnings confidence gets support and buyers get more room. If manufacturing looks strong but inflationary, or weak enough to hurt demand, sellers get another reason. So the balance setup is simple. Calm wages, steady jobs, and stable manufacturing help the bounce. Hot wages, a yield spike, or ugly demand data makes the bounce harder to trust. My personal read is simple. This jobs report can be a problem for the bulls, because traders are acting like labor will land perfectly, and I do not buy it. The full read is still that the broader uptrend is alive, but I do not think this is an easy chase anymore. Again, the market just came through a week where tech broke leadership, PCE stayed too hot for comfort, and fear moved fast enough to change the tone. The macro driver does not replace the level. It changes how much proof buyers need before I trust the next push. Last week I told you the upper decision area mattered, and now the market is proving why that warning was the right lens. The key resistance zone near 734.4 is the first line I care about now because buyers are close enough to press it, but they still have to prove they can hold it. Again, price can keep pushing higher, but I would not blindly chase it into that resistance area without a stronger close. RSI at 43.2 is not washed out, so the market is weak enough to be damaged, but not stretched enough to make a finished low obvious. Lower Bollinger area is where the current structure sits, and that tells me price is still trading in the lower part of the range instead of reclaiming control. Open gap above around 739.6 to 743 is unfinished business, but I do not want to fast tag and fade there. I want real acceptance. Again, MACD is still below zero, so the pressure has not been worked off yet, even if sentiment is stretched enough for a bounce attempt. VIX also has not behaved the way I want to see at a finished low, so buyers need volatility to calm down while price pushes. For me, the current market only starts to reassert the uptrend if buyers push toward resistance and still look firm into the close. If they just tag the level and fade, then sellers still have the better short-term argument. Okay, so what does all this mean for the next move? Let's shift the chart forward and look at what could come next. The path I would give the edge to is still controlled continuation, but only if buyers hold the active structure and press back toward resistance without getting sold right away. The overhead resistance cluster around 734.4 is the first real test. If buyers absorb that area, the market can start repairing instead of just bouncing. The overhead gap around 739.6 to 743 then becomes the next problem, because filling a gap is not enough if price cannot hold above it. The upper resistance cluster around 760.4 is the next supply area if that first resistance test gets absorbed cleanly. The larger upside objective would only start to come into view near the measured move target around 787 if buyers keep control through those resistance checks. Again, that target is not active just because it exists. It needs a confirmed hold and follow-through above resistance. If that first push fails, the cleaner risk path is a pullback first, with price cooling before buyers get another real chance. The support cluster around 690.5 is the pullback zone I would watch if sellers reject the resistance test and force a deeper reset. Support near 690.5 is not automatically bearish if buyers defend it cleanly. It can still be a corrective reset inside the larger trend. Again, as long as buyers keep the active structure alive, I treat pullbacks as corrective first, but if they lose the breakout structure instead of holding above it, the bullish read weakens fast. Do we get the gap and go, or do we reject into support first? That is the whole decision into the next tape. That is the full weekly market recap for June 22nd through June 28th. Watch whether buyers can defend the pullback, respect the 734 area as the next real resistance test, and let the close confirm before chasing. Thanks for watching, stay sharp, and I will see you in the next market recap.